Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. European futures are in the green and Asian stocks head for their highest close in the month after US and global shares hit fresh all-time records. But Broadcom earnings could weigh on sentiment into the US session as the chip company fails to meet investor expectations and its stock drops 5% after hours. Plus, Donald Trump signals the US could help with Ukraine's security as part of a peace deal. This as President Zelensky floats the prospect of a referendum on handing over land to Russia.
OK, let me translate what Anna just said into numbers and put it on the screen for you. Euro Stoxx 50 futures up by 0.5%. The S&P hit a fresh record high. A lot of that came later in the session. Europe still needs to price it in. That's why you're seeing that number. That's a rearview mirror look. Looking forward, though, Nasdaq futures are actually negative this morning. This is the Broadcom story. We'll come back to that in just a minute. Broadcom down after hours. In terms of the geopolitics, this is the story. Brent crude up by 0.5%. In some ways, you could argue that the Ukrainian story should be negative for crude, but take a look at what's happening with Venezuela as well. That could be positive for crude. We're going to track that action. Has Brent crude bottomed out is a key question right now. Anyway, the countdown to the opening trade starts right now. Good morning, Friday morning. So another tech heavyweight spoiling the party a little bit overnight. Yesterday it was Oracle. This morning it is Broadcom that we are dealing with. Yet, despite all of this, US equities hit fresh record highs yesterday. We're just edging off a little bit this morning. But the Broadcom story is interesting. Again, it's this lack of specificity when it comes to the AI outlook, which Broadcom couldn't deliver on the call. And that is what is causing concern in terms of the share price.
Yeah, absolutely. This chip company then, as you say, sets away on the US session when we get to that, and certainly on the Nasdaq. So what investors wanted was clarity about the payoff around AI. What they got was a vague timetable, no revenue forecasts that really gave much detail about 2026, and that wasn't enough, and the stock fell 5% after hours. And that's just part of the sort of web of tech news we've had out this morning.
You do need to zoom out a little bit. Broadcom has had a great run, and in some ways, therefore, the bar was incredibly high. But it did seem as if there needed to be a matching of that expectation, and there just wasn't. And I'm wondering why there isn't this specificity. What is it that this company sees? And these are the companies that provide the shovels for this AI kind of boom. It's the Nvidias, Broadcoms, etc., that are providing it, and they're also aligned with Alphabet as well. What is it why can't they give us a clearer outlook? I thought the data center boom was on rails right now.
Yeah.
And as a result of which you should have lots of clarity as to where everything is going.
Yeah, maybe the problem is in what they say, maybe the problem is in our expectations. There's a mismatch somewhere. But interesting vote of confidence for the AI story and the AI infrastructure build-out. Masayoshi Son, interested in data centers. He's talking about, our reporting is talking about how he could be after Switch Inc., a data center business. And, you know, that's a new departure for him, or an expression of interest in another part of the AI spectrum from SoftBank, which could be of interest.
So he's selling out of OpenAI. Could be interesting timing, actually, with historical hindsight, great view of the situation. And then looking at the data center story. But those two things don't sit side by side. Why can't Broadcom give me greater guidance? Why can't Broadcom, which should have fantastic visibility on what is happening, and all the money that is being spent, why can't it give me guidance? Why is Son so interested in what is happening with the data center build-out? There just seems to be some misalignments at the moment.
Yeah, investors sell, and whilst they ask those questions, I suppose. Interesting that OpenAI feeling the pressure. GPT 5.2, the new model, that's being released, and this is all about that competition with Alphabet, with others, with Google and their product in this space.
Absolutely, and the last models they've released have not been received that well. So it's going to be interesting to see how this is taken. Also, it speaks and talks back to this idea that there's kind of this red alert at OpenAI that it needs to focus on getting these models out. The competition is Alphabet. It needs to beat Google.
Yes.
And it needs to make sure that happens. And it'll be interesting to see whether this model lives up to that kind of red alert expectation.
Yeah, absolutely. Let's move on to the Fed. Here we have some interesting developments. Took a while for me to get my head around this story, Guy. I'm not going to lie this morning. 11 regional presidents, because we've been waiting for this, and yet it seems to have come in a way that maybe I wasn't wasn't anticipating. So 11 regional presidents were confirmed yesterday. They get new 5-year terms. There had been some expectation that in order to influence the confirmation of these regional presidents, that President Trump might try to change more of the Board of Governors, and that would have then had an impact on this vote. But that hasn't happened to such a degree as had been feared.
This has clearly come earlier than anticipated. I think a lot of people were looking forward to this happening in the new year, and you bring up Lisa Cook, and that is why the Lisa Cook case that is coming pending at the Supreme Court is so significant, because if Trump had been able to stack the Board of Governors, he might have had the ability to shape the regional president's story. That now is not going to happen. But what is interesting on that note is that Waller, Myron, all voted for this. This was a unanimous decision.
Yes.
So you had the Trump appointees basically coming through and signalling that they were okay with this, which you would have thought implies tacit acceptance from the White House that this is the way to go. I don't know whether or not that is the case. And there's also this whole issue of Scott Bessent asking for the presidents to live in the regions that they vote for, and I'm wondering whether that could still provide a wrinkle. But it does appear as if the White House has backed this. So you got Myron, Waller and Bowman all backing it. They, in theory, should have been the Trump story.
And maybe this tells us something, or maybe it doesn't tell us anything about the way that the Fed is going to operate under a Trump-appointed chair, and that's going to be, of course, the big event of the spring of next year.
It implies that the chair is less important, maybe. And I think that's one way of looking at it. And you could, at the edge, take this as being a slightly hawkish signal, therefore. Let's talk about oil.
Yes, absolutely, because oil, there's a couple of different strands here. There's a lot of news flow around Ukraine, so let's deal with that first. There's talk of weekend meetings. We'll see if those deliver anything. President Trump says he's frustrated, of course, with both sides, but he has committed to do something for Ukraine's security if there is a deal. Frozen Russian assets, that'll be part of the conversation today as finance ministers meet. All of this has the potential to put downward pressure on oil prices, perhaps a little bit.
Maybe.
On the other side, there's the Venezuela story, which has the potential to push oil prices a little bit higher.
So the Venezuela story is interesting. They've sanctioned a further series of tankers, which therefore would put those tankers at risk of potential US interference. So that is one to watch out for. Clearly, they've figured that this is the pressure point they want to apply to Maduro to get the Maduro regime out. But then you kind of extrapolate further forward and you say the Maduro regime were to fall, would that be negative for oil prices? Because actually, in theory, therefore, you could remove some of the sanctions that are applied currently to Venezuelan crude, and that would obviously be released, therefore, onto the market more easily. Yes,
absolutely. If it all comes back into the mix and it's not just going to China and places that don't care about US sanctions, and it's going into Western markets, then that would be quite a game changer. And the other long-term question hanging over all of this is all of this national security strategy from the United States, which has hugely shaken people here in Europe. Mark Rutte using very alarming terminology yesterday, talking about the future of Europe. And all of that feels too far away for oil markets to care about. But at some point, that's big stuff. Attention. That's big stuff, and everyone's paying attention, and it's got to get into markets in some way.
Just back to the oil narrative, though. So what is interesting is that other commodities have been rallying recently, and therefore you could argue that there's an inflation impulse within some of this, within the commodity price. Simon White wrote a great piece yesterday on the Bloomberg talking about this. Oil has been the outlier, but if oil bottoms because of geopolitics, that kind of removes it as being this kind of alternative factor to the other commodity story that we are potentially seeing. So you could argue that a bottoming crude price is at the margin hawkish, because it's inflationary.
Let's just get to some data we had out of the UK, because it's disappointing, so it deserves our attention. The UK economy contracted again in the month of October. So this is just the monthly number. So on the one hand, just monthly, it's not the whole thing. But GDP fell by 0.1% in October. That repeats what we saw in September, which was a contraction of 0.1%. And we had expected growth. So it continues the contractionary environment that we saw running into the budget, and it comes in below estimate. It has sent, maybe this is all price, because it sent the pound down off its earlier highs, but it's sort of rebounded back to the flat line-ish.
Maybe-ish. What is interesting here is that there's this growing sense within the UK that the UK has to figure out a growth strategy, and that the Labour government currently has not got one. And it's going to be interesting to see, you're starting to see grassroots movements beginning to emerge in the UK talking about growth and how growth is the imperative. And it's going to be interesting. I'm fascinated to see how that ultimately comes into the political narrative. And today's data will just further reinforce that.
Yeah.
Where is the growth in the UK? How does the UK grow? It is incapable of it at the moment.
And how does populist politics, either green or reform, how does that fit with a growth agenda? We'll wait to
is there a kind of...
see.
I see those kind of more extremes, but I'm wondering if there's a kind of centrist growth kind of... We just need to get this sorted kind of narrative that may ultimately emerge. What have we got coming up on the show? We're going to talk about all of this. Nanette Hechler-Fayd'Herbe, Lombard Odier's EMEA CIO, is going to be joining us. Hilary Maxson, Schneider Electric's CFO, is going to be joining us as well. That's the data center story. It's around a quarter of their business. I'm fascinated to hear what the outlook, therefore, is. CMG, Christian Mueller-Glissman, apparently that's what he's called internally. Goldman Sachs is head of asset allocation, joining us from Goldman Sachs Asset Management. And Maria de Mertz is the Conference Board Economy, Strategy and Finance Centre leader, is going to be joining us in Europe. If there was peace in Europe, if there was peace in Ukraine, what would that mean for the economies of Europe? I think is another key sort of broader question that we need. Would it give Europe a boost economically? Yeah,
from a market's perspective, we often track what's happening with the defence names, but from a broader economic peace dividend perspective, a lot to think about. It is set to be an unusually busy third week of December next week, so we thought we'd give you an early heads up as to what to expect. So on Tuesday, we get US non-farm payrolls. Wednesday, UK CPI. Thursday is busy with central bank rate decisions from the Bank of England and the ECB. Plus, we get US CPI. And then on Friday, we get a BOJ rate decision. I'm exhausted already, and it's Friday the 12th of December. We have another week of this to go.
Absolutely. Good luck. Will the ECB... How many questions will Lagarde get on rate hikes?
Yeah, absolutely.
I think it's going to be really interesting. Will the BOJ deliver a rate hike, and what will it signal in terms of the rate hikes that it potentially could move forward with?
And how much will we see what real dissent looks like at the Bank of England?
Absolutely. And is the Bank of England... How close to neutral do you think the Bank of England is? How close could it get? How close to the end of this rate cycle could we be for the Bank of England? And the data certainly paints a fairly bleak picture, but the inflation story is still sticky.
And this growth story. I mean, 2 months in contraction now. That adds almost. That's 2/3 of your way to a negative quarter.
But yeah, precisely. But you've got poor growth and still sticky inflation. What does the bank do with that? Anyway, what else do you need to know this Friday morning? A group of centre-right Swiss lawmakers has proposed a compromise in the debate over UBS's capital requirements. We understand the proposal suggests allowing UBS to meet demands for extra capital, in part by using AT1 bonds. The plan supports the government on the total amount of capital support while seeking to take the bank's competitiveness into account. Basically, AT1s are a less onerous form of capital and would be therefore cheaper for the bank. Bulgaria faces a fresh wave of political turmoil just weeks before the country joins the euro. After street protests over rampant corruption, the country's prime minister stepped down after less than a year of running a minority government. The resignation paves the way for Bulgaria's 8th election since 2021. And Disney shares closed higher in the United States. This after the company announced it's licensing some of its iconic characters to OpenAI for use on the startup's video platform. Disney has also agreed to take a $1 billion stake in the startup. While the deal covers some of the firm's more famous characters, it does not include talent likenesses or voices, because that's the big fear. It basically turned the whole of Hollywood into a huge OpenAI experiment. But it's interesting that it does seem as if Iger's done an interesting deal here.
It does, because this story is either about the lack of power that content creators have in an age of AI, or it is about them exerting the power that they still have against at least some of these AI players. And certainly there was that take by some of the voices at Bloomberg Opinion overnight, which was interesting. 7:13 here in London. Coming up on the programme, we will bring you our exclusive interview with the CEO of ASML. He's been speaking to Tom McKenzie. ASML, of course, Europe's most valuable company and one of the most important cogs in the global AI supply chain. He tells us his plans for keeping up with the competition. Plus, Lululemon gets a new CEO. Will he give the share price a leg up? Very nice. Up next, back to the markets. Tech and the Fed are top of our investor agenda this morning. We will discuss those shortly. If you want to get involved, please do get in touch with the team that puts together this programme. IB plus BBTV Go is the function to use on the Bloomberg terminal. Live from London, this is Bloomberg. Welcome back to the programme. 7:17 here in London, and European equity markets set to catch up with some of the gains that we saw towards the end of the day in the United States, or at least the second half of the day. And so we've got some catch-up to play there. Looking ahead, things don't look quite so rosy on Wall Street, so we'll see where that heads. But yesterday still told us some really interesting things about the way the market is functioning right now. US stocks ended a choppy session higher, with the S&P 500 hitting another record high, the first since October. That was despite weakness in tech. Let's bring in Bloomberg's Valerie Teitel. And we've been asking for some time how US stocks will fare if the AI trade in any sense stumbles or rolls over.
No, this is very interesting that we notched yet another record high in the S&P 500, but it wasn't led by the AI trade. It wasn't led by those mega cap tech trades. It was led more by this rotation into value stocks. I've got the Russell 2000 index behind me as my proxy for value stocks. They really outperformed in the session yesterday despite the weakness in tech, with the Nasdaq closing in the red. And this has really been a theme of December, a theme of the last month. Take a look over the last 30 trading days. The Russell 2000 index is up near 6%. The S&P 500 and the Nasdaq are essentially flat, up less than 1% over that time frame. This has been, for some, a painful rotation out of those heavily positioned consensus longs in tech into more value stocks. So it has been painful for the equity trade of late to see this happen into year end. Perhaps it's just resetting the bar of these AI valuations, or maybe it is just those taking some chips off the table of what could be a very busy week, the very busy week next week, a third week of December. Not only do we have 3 central bank decisions, the ECB one just got a bit juicier this week, but we also have delayed data out of the U.S. The non-farm payroll report comes on Tuesday, and then we have CPI on Thursday. A lot of these data points next week, a lot of these risk events could really change the bar to the market's thinking of how central banks will react in 2026.
Are we going to get a surprise this side of Christmas? That's a big question. We've seen them in the past. Are we going to get another one? Valerie Teitel, thank you very much indeed. OK, let's unpack some of this and figure out what is going to happen next. And it's Hechler-Fayd'Herbe, EMEA CIO at Lombard Odier, joining us. Good morning. There's plenty of surprises that could emerge by year end. Does it feel like we're done with 2025 at this point? Do you think the BOJ or the ECB, the Bank of England, or maybe some of the US data could shock us a little bit? What else do you have on your scorecard for the rest of 2025?
Yeah, there's the known unknowns, and then there is the unknown unknowns. So among the first group, obviously the BOJ, and for example, the guidance that they are going to give, very important for the yen. We think the yen is undervalued at this point, so we really could see a catalyst here emerging for appreciation. And then in the second group of what is more difficult to assess, at least from a financial market impact perspective, is how political developments are continuing in Europe with respect to the seizure of the Russian assets potentially, and in the US with respect to the Supreme Court ruling on the constitutionality of tariffs.
OK, just focusing on some of those. Why are you concerned? What is it you're watching for within the seized Russian asset story here in Europe? How important is Ukraine to your outlook?
Macroeconomically, I don't think we are going to see material impact one way or the other. This is the story of the last years. Actually, in Europe, there has not been such a big macroeconomic impact from just simply the situation in Ukraine. But when we are looking at some of the impacts potentially on the Russian assets, we have to keep in mind that the stock rally in Europe has been very much driven by the financial sector, not only this year, but also last year already. And so anything that may be changing the perception of safety with respect to European financial sector altogether is a risk for us to bear in mind.
That's interesting. So you see this, Nanette, good morning to you. You see this as something that could weigh on the banking sector in Europe. Is there some legal safeguards that could be put around the seizure of these assets that would mean that European banks are not on the hook for anything that might transpire in the future?
obviously you're speaking to a financial specialist, not so much a legal specialist. So I'm very, very keen to understand what type of risk premia are priced in markets at the moment. I don't see any priced, and that's what I focus on.
Okay, now that makes sense. You also talk ahead of our conversation in your notes, Nanette, talk about geopolitical fragmentation and how what we're seeing being created is a slightly higher neutral interest rate as a result of that, as a result of disconnection around the world and reshoring of production, I imagine, in certain geographies. How are you playing that? Does that come out as an opportunity, a strategy?
Well, altogether, this fragmentation is, in our assessment, really starting the revival of emerging markets and emerging market assets. Not only do these countries have a very different demographic setup and are now benefiting from a younger population coupled with the technological progress that artificial intelligence and a very rapid adoption in emerging markets is going to bring. So they, as if, could really benefit from the full impact of the productivity increases. And we think the geopolitical situation that on top of it is giving commodities, again, a very strategic weight is favorable for emerging markets. So our outlook macroeconomically for many emerging markets is positive. And then the assets are compelling because in equities, the valuations are much more attractive and the sector composition is the right one for the current geopolitical setup. And finally, on the bond side in fixed income, these are some of the most compelling yields for the credit quality that we are finding this time around.
Yep. Okay, can I just break that down a little bit? If we're focusing on commodities and we think commodities are going to be a story going forward, does that imply that we are going to see an inflationary push in 2026? Is inflation going to go higher next year, driven by some of these commodity prices?
I think we have to really unpack that, because inflation, when you dissect it, for example, in the United States, is going to depend a lot on what's going on in services inflation. This is a very important part of it. And that services inflation in turn is depending more on the labor market condition and therefore on the business cycle in the US. Then when you come to energy and commodities inflation, there indeed I think that there is less room to the downside. And then finally, there is the impact of tariffs on inflation that is most likely to be like typically a VAT increase. This is what we are all much more accustomed to than tariffs. And that is likely to wash out over time.
Where does that leave you on commodity exposure then, Nanette? Because I noticed, gold has attracted a lot of attention this year.
Yes, gold shining by all its lights, absolutely. It has brought us to not only have gold in our strategic asset allocations as a perfect diversifier, because its drivers are really something else than for the rest of financial assets. And on top of it, for 2026, we think that there is a structural trend here that is likely to bring gold prices up even further. So we have at the margin even increased a little bit this exposure. Generally, we think favorably of commodities. Commodities are in a structural uptrend given the importance of commodities in the whole technological revolution.
Okay, let's just finally, I just want to ask one final question. Are we going to see rate hikes from major central banks in 2026?
Well, the Federal Reserve has told us that as far as they are concerned, there is still some asymmetry, more in the direction of lower rates. This is also what we expect. 3 more rate cuts, in our view, of 0.25% in the second half of 2026. Really, the only bank that we are seeing as the one that is having a very strong case for several interest rate increases is the BOJ, the Bank of Japan.
Okay. Nanette, thank you so much for your contribution. Good to see you. Have a good weekend. Nanette Hechler-Fayd'Herbe, EMEA CIO at Lombard Odier. When we come back, we'll be speaking to Schneider Electric's CFO. Lots of news on that front this week. This is Bloomberg.
Friday the 12th, good morning. 30 minutes to the start of equity trading here in Europe. The futures picture looks fairly positive. This is a rear-view mirror story, though. The S&P yesterday hitting fresh record highs. It hit them late in the session, as a result of which we have a little to price in here in Europe. And as you can see, that amounts to, let's call it circa 0.5% here in Europe. In terms of the bond market picture, let's take a quick peek at what is happening here as well. We're watching very carefully as we embark on a busy week next week in terms of what the bond market story is going to look like. Germany, France and Italy, though, this morning on offer, but not by much.
Yes, and we'll certainly watch to see how the gilt market opens in half an hour after that disappointing GDP data. What does that do to our expectations and those built into gilt markets about what the Bank of England does next week? Let us turn our attention to the data centre build-out and companies that have been benefiting from it. Schneider Electric has announced a share buyback programme during its Capital Markets Day of as much as €3.5 billion through to 2030. This as the company targets growing profitability over the next 5 years, driven by AI and electrification. We're pleased to say we're joined now by Hilary Maxson, who's Schneider Electric's Chief Financial Officer. Hilary, really nice to have you with us in studio. Thank you for coming in. So you just had your Capital Markets Day, and we hope that's gone smoothly. What kind of message were you giving to investors who assembled around the data centre build-out story and what you're seeing at the sort of the forefront of that, about whether it's slowing down, whether it's just relentlessly expanding? What's that narrative looking like?
Yeah, well, thanks very much for having me. And one thing I'll start with is we did update our end market exposures yesterday. So 25% of what we have is data center, and not just AI data center, all data center. We've really been for decades in the business here. I think we're the clear market leader. We mentioned yesterday that we're in 95% of hyperscaler data centers. As you can imagine, we have actually quite a bit of insight in speaking to our different customers, the hyperscalers, the colos that they work with, and the rest of the enterprises that also still do data center. And there's a lot of cycles in the news, actually, and the up and downs. But in terms of overall demand, for the past couple of years with our customers, we really haven't seen that cyclicality. That demand is there. They see an opportunity for AI as a new technology, a new thing that they can sell to their own customers. So we continue to see strong demand in that space. Actually, we gave a new target, a 5-year target for what we expect in data center network overall from a market growth standpoint. Pure data centers at 12 to 14% growth over the next 5 years.
OK, so you bring us no gloomy stories about the rollout of data centers, which is interesting because here in the news business we're fickle and our head is turned by the latest bit of news flow. So it's interesting to get that slightly longer term, and 2 years feels like a long time, longer term perspective. Now, you've announced this buyback for shareholders, possibly as much as $3.5 billion. I wonder, when you're in such a growth industry, what analysis goes into that decision as to how much to return to shareholders? Because you must have lots of choices about what to spend that money on, given the growth. So why return it?
So we are a strong free cash flow business. That's been the case for a long time. That's the business model that we have. The last share buyback we announced was in 2019. That's the last official share buyback we announced. We completed it in around 2022. Since then, to be fair, each and every year we do some level of share buyback at a minimum to offset employee share plans. So we thought over this next 5 years, it would make sense to put that into numbers for investors instead of being more vague, so that 2.5 to 3.5 billion euros is what we anticipate to give back to investors as a small percentage of the free cash flows and the liquidity that we would have as a company.
You're increasingly separating out your research. I think it's four main kind of hubs, but two are the kind of the big ones, China and the United States. What is the need to do that? Why is there a need to do that?
So each of the markets that we operate in, and we talk about 4 main hubs, one in India, one in China, one in North America, one in Europe, are a bit different from a market standpoint. So we've always talked about being the most local of global companies. So we really want to be on top of the trends in those various markets. So we don't lose the global platforming of our R&D, but we really want this good loop of R&D to sales, to supply chain in each of the big areas that we operate, so we can deliver the right stuff to our customers.
How different is the stuff that the customers want in the United States and China? How different are those two markets from a grid perspective, from a data center perspective?
Well, based on the different dynamics in those markets, China is a bit further down the path in terms of sort of the electrification economy.
Yeah.
Quite a bit of the cars there, when you're driving around, they have a different license plate, are all EV at this time. So they're moving much further down the path of what we would call more of a hybrid electrification landscape between AC, alternating current, and DC direct current. The U.S. will eventually get there as well as everyone upgrades their grid infrastructures over time, because lots of stuff we have now around us is direct current. Our cars, our phones, our computers.
Yeah.
So eventually all of the economies will probably get there.
How much further? The Chinese economy sounds more electrified. How much more advanced is the grid? What's the gap between grid technology in China and grid technology in the United States? It looks like the US has got an electron gap. China doesn't. Can you describe for me the differences in those two markets? Because I'm seeing more and more being written about this.
So I'm not a technical grid expert.
Sure.
However, it's true that China has developed their grid quite a bit. It's been a big focus and a big focus of the state over the last years. They also have a lot of industrial industry, right? So it's very important that they have that electrification. The U.S., the Western world, we've seen even pre-AI data center that there's some need for upgrading in the grid, and that continues today. So there's a huge need in the Western world to upgrade the grid, and now there's more demand for electricity, so there's need for more supply in the grids as well.
Yes, and sticking with that grid story, I mean, some of your customers must be facing delays getting those grid connections. We talk about that in various geographies in Europe. Is that something, Hillary, that you see amongst your client base?
Well, we'd mentioned yesterday that in terms of data center and network, 61% of what we have there is in North America. And part of that is because there's been a bit of a delay in data center rollout, particularly AI-related data center rollout in Europe, associated with permitting, with electricity and access to electricity. We would expect that to catch up. Hard to say exactly when, but I'm certain that that's something that
where is that delay happening?
On.
Where's the delay?
It would be different country by country.
But just everywhere in Europe?
But indeed, we start to see a little bit of loosening up in places like France. But it is something the governments seem focused on. So we would expect that there would be opportunities in Europe over the coming years.
Is this gap that exists, this need to electrify kind of almost regardless, what gives you confidence in your outlook? Your outlook is very assured. We're kind of, this is where we're going, this is what the picture is going to look like. As Anna says, there's kind of wobbles in the news flow. Everybody doesn't know kind of whether or not we're going to see kind of what's going on with Oracle and what's going on with OpenAI. If we were to see a shakeout in the AI industry, we're still going to need a lot of data centers. We're still playing catch up. The grid still needs advancing. Is that what gives you kind of this underlying sense of the fact that we are going to still need to invest in this stuff, and therefore that kind of extrapolates into your outlook?
Well, we talked a lot yesterday about the fact that we're going to the next level of energy and industrial intelligence. So you just talked about issues, for example, with developing data centers because there's not enough energy. There is a huge amount of latent opportunity all around us in freeing up energy with digitalization and AI. So really working across all those levels of understanding the electrical landscape in order to deliver energy efficiency into these grids, into data center. So we work across the whole life cycle. In terms of AI and data center itself, that's an area where we're working across that whole life cycle. Even after you build your data center, all this money going into these data centers, there's a huge opportunity then that people will want to move to optimization of this infrastructure that they've built. But over this coming 5 years, like I mentioned, we do see that 12 to 14% growth in the data center market.
And I still wonder if some of those will be in space, Guy. We started the week talking about the possibility of data centers in space.
I'm mildly obsessed with it.
I'm still transfixed by this idea. Hillary, any conversations about space right now?
Not yet,
Not
but
yet.
I
Not
agree
yet,
with you.
Space seems to, it's interesting. You ask this question to a lot of people, and they're like, what happens next? I was talking to somebody in the travel industry kind of last week. Yeah, space. Next,
Okay.
that's the next tourism story, and maybe data centers and electrification is the next story as well. Hillary, very nice to see you. Thank you very much. I'm sorry, we're kind of going completely off topic. Thank you very much indeed for joining us. Hillary Maxson, the Schneider Electric Chief Financial Officer. Coming up, global competition for AI supremacy is in full swing.
Today, there could be a debate about will the US or China win the AI race. I think it's clear who is losing it today. It's Europe. Europe is behind.
We're going to hear more from our exclusive interview, the ASML CEO. Got that out? That's next. This is Bloomberg. "16 minutes to the market open. Let's talk tech." In today's edition of Bloomberg Tech Europe, Tom McKenzie travelled to the Netherlands for an exclusive interview with Christophe Fouquet. Who is Christophe Fouquet? He is the CEO of ASML, Europe's most valuable company and one of the most important cogs in the global AI supply chain. Fouquet gave his thoughts on whether Europe can catch up and eventually win the AI race.
If you look at the overall AI ecosystem in Europe, it's very weak in any way you look at it. And today there could be a debate about will the US or China win the AI race. I think it's clear who is losing it today. It's Europe. Europe is behind. And it's true with semiconductor, right? If you look at semiconductor, basically take our shipment. The shipment of our system to Europe today is maybe 1 or 2% of our total business. And that's been the case for the last 10 years. So there is no buildup of semiconductor manufacturing in Europe. Not advanced, not mature. Why is that? Is because there is also no consumption of semiconductor in Europe. Most of the consumption, as I said, of advanced chips are in the US because the company that develop the AI chips are not here. So Europe is behind, and to catch up, Europe has to create the condition basically to attract this entire ecosystem back to Europe. And that's a major task, to be honest.
Because we have the engineers, we have the researchers, we have ASML.
Yeah.
But Europe does not own the chip space.
Well, we have the engineers, we have the researcher. I would say we have the market. I think the European market is a great market.
That was the ASML CEO, Christophe Fouquet, speaking to this guy, Tom McKenzie, who joins us around the table. What are your big takeaways?
A number of key lines on China, on the demands coming through from NVIDIA, and on just how far Europe is in that AI race. He said it's clear that Europe is losing. This is a company that, for people who don't have exposure, is arguably one of the most important companies many people have never heard of, because it makes these lithography machines and it has 100% market dominance at the top end. At the top end, it completely
sort of
dominates.
Extreme ultraviolet.
It's the only company that makes these. They go into the foundries of TSMC and Samsung. You can't have NVIDIA's top-end GPUs without these machines that go into the foundries. On the question of Europe, he was making a clarion call there for a big focus, not just in terms of building a comprehensive AI ecosystem in Europe, but also a chip industry, and saying that he ships just 1 to 2% of their sales into Europe versus Asia,
which is
and the US, just 1 to 2%. And he said that's happened over the last decade. On China, he also said, look, China is not going to allow itself to be cut off from cutting-edge technology. He has been a proponent of wanting to ship at least some generations of their machines into the Chinese market. Right now, the machines they ship in are about 18 generations, 18 generations behind the ones that we can get access to or the US can get access to. He is making the case that we need to engage with China in this ecosystem. So he aligns more closely with Jensen Huang on that front.
Yeah, so he wants, if someone's going to have the market, he'd like it to be Europe. Jensen Huang would like it to be NVIDIA and the United States. Sticking to the Europe theme, or coming back to that, Tom, really interesting what he said there about Europe being behind, because we were just talking to the Schneider Electric CFO, who was saying that, yes, from a permitting and grid connection perspective, so many of those types of factors holding back the setting up and the rollout and the development and build out of data centers in Europe. I mean, that ties in very nicely with the line we're hearing, sadly, from ASML as well.
So it does. And he raged against regulation in Europe. So regulation is a factor, just the capital as well. And that brings us on to the question about whether or not we're in an AI bubble. And on that front, he said, at an industrial level, no, we're not. There's going to be a lot more going in to building out this industry. He says when it comes to valuations of stocks that have exposure in the AI space, that's a different question. And he raised the prospect of maybe that things are looking a little frothy on that front. But he says there's going to be multiple cycles of investment in the infrastructure because, of course, you get to new chips like the Rubin that's coming out from NVIDIA next year. As that happens, you have to rebuild those data centers or at least refit them. They expect to benefit from that, at least for the next decade. Their next machine is the high NA, the high numerical aperture lithography machine, basically the next generation, which is going to become mass volume in 2028. Intel already has one of these machines and is testing it. They think that's going to be a high volume product in the next few years.
Just explain, and I'm sure there's an obvious answer to this, why does he have visibility and Broadcom is struggling to deliver it at the moment?
So Broadcom is designing the ASIC chips. So these are designs that you can adjust to your customers' preferences. So they work with the likes of Google and OpenAI and Meta and Amazon, reportedly on designing their own AI chips. You've got NVIDIA's GPUs, then you've got the ASICs that Google has shown are very, very powerful and effective in terms of their TPUs, those designs. Broadcom is not able to give that 2026 guidance that analysts were looking for. It's interesting because CEO Christophe Fouquet at ASML, he sits down with the likes of Intel and Samsung, and they plot out years ahead.
That's what I'm surprised.
So why Hocktan is not able to give that guidance into 2026? I'm not sure, frankly. These are chips that are still in development, so it's still in the early stage. It's complicated getting the designs together, matching what you're able to do for your customers, what their demands are in terms of performance, in terms of energy, in terms of whether or not they're for training or for inference. So there's a lot of complexity here. They do have these orders coming through, 11 billion from Anthropic in the most recent quarter, but margins are being squeezed. We know that. They have that backlog of $73 billion US. But as some investment bankers I was speaking to yesterday said, this is very asymmetric in terms of how the market reacts to these companies. If they're seen to even be wobbling on that demand picture into the future, then they get punished, and you see that asymmetric response in the equity markets.
Tom, thank you very much. Our Bloomberg colleague, of course, Tom McKenzie, with the latest on the tech sector and that fantastic conversation with the ASML CEO. You can find the full thing, of course. It will play out a number of times on Bloomberg TV, but it's also available on our website as well. Joining us now with a look at the markets, let's broaden our lens a little bit. Our Markets Live reporter Adam Linton joins us this morning to talk about the market in 3 minutes. Very nice to see you, Adam. We've had some disappointing data out on the UK growth story this morning, which has me wondering what gilt markets are going to look like at 8 and what they're going to start pricing in. What's your thinking around the UK right now?
Yeah, obviously, the GDP data was a disappointment this morning, but this is monthly GDP, which does have a tendency to be volatile. Yes, growth is relatively sluggish, but I think actually next week's data slate is probably going to be more incremental for the UK. Got inflation, got the labour market, PMIs, retail sales, and I think that'll probably provide more guidance for what to expect from the Bank of England. I mean, yes, next week we're expecting a 25 basis point rate cut, but I think really, the vote split is going to be more interesting. We've still got this real hawkish contingent on the Bank of England. I think there's a group of 4 who haven't backed a cut at any of the last 3 meetings. So I kind of think if those are kind of started to splinter and how kind of Bailey presents any comments that he makes after the media rounds, I think that's kind of set up the gilt markets. And also some of the positivity we saw in the wake of the budget. There's some potential headwinds for that. We've got political risks, we've got the May elections. We've also got quite a lot of uncertainty as to when some of these revenue raise measures are actually going to kick in. If they kick in at 2029, that's an election year. Are they really going to be hiking taxes in the run-up to that? Not too sure.
It was a buy now, pay later budget, wasn't it? What does that mean for the gilt market? The gilt market at the moment has been kind of becalmed a little bit. But you do wonder whether or not some of those... When do you see some of those risks re-emerging? Because one of the consensus trades, it seems, going into next year is actually that the gilt market could do quite well. But is there risk to that trade?
Yeah, I think there's definitely risks. I mean, I've actually written a column on this today on the macro view column. And, political risk, May elections. We don't know who's going to be running the Labour Party.
Yeah.
3/4 of those revenue-raising measures, they're going to kick in around the time of the election.
Yeah.
How are they going to square that circle? And that then has a massive credibility hit potentially. And also the OBR's consumption expectations are very, very upbeat. Bloomberg had an article that potentially she could face a 40 billion hit if they don't materialise. So I don't think gilts are out the clear at all. And also the Bank of England, there's only limited room to cut to the downside. Bloomberg Economics thinks neutral could be around 3.5%. They cut 25 basis points next week. That leaves them just 25 basis points to play with.
OK. We've also got an ECB rate decision next week, Adam, and there is no expectation that we get a cut there, and increasing talk about when we might get a hike. What's your thinking on that?
I just don't think the case for a hike really exists at the moment. The Eurozone economy isn't exactly running hot at the moment. It's been resilient, not hot. I think the key thing to watch is that 2028 inflation projection. That comes in below 2%. We're in a situation where all of a sudden the ECB could be forecasting inflation below target for 3 years. I don't really see where the hike case comes from that. And I think we could potentially see that refocus minds a little bit next week.
OK. Great to see you. Thank you very much indeed for stopping by to see us. Bloomberg Markets Live reporter Adam Linton. Remember, you can catch up the whole of the team. Fantastic news. MLIB Go on your Bloomberg terminal. What are we watching in terms of the stock market story this morning? Lululemon maybe in focus. What do we say? Athleisure. Haven't heard that word for a while, Louise Moon.
Heading into the weekend, thinking of athleisure, exactly. So we're looking at athleisure stocks in the UK on the back of Lululemon's positive news overnight. They've boosted their outlook, they've announced a new CEO, and there's some hopes for a bit of innovation there. So potentially this could feed through into the European-related stocks. We're looking at Adidas, Puma, JD Sports, Frasers Group. Not a great picture so far from them this year, except for Frasers Group. That is slightly higher so far this year. So we'll be keeping a close eye to see if that kind of ripples through into the European market, that positive news from Lululemon. Next up, we're looking at Generali, the Italian insurer. So there was going to be kind of one of the biggest financial deals in Europe, two asset managers combining Generali and BPCE in France. That's now not going ahead, so we'll be keeping an eye on Generali to see if it impacts their stock or not today. Analysts are kind of saying, this doesn't impact their investment into Generali, so potentially won't weigh on it too much, but we'll be keeping a close eye on that. And then finally, Standard Chartered, they've been upgraded to buy by Goldman, adding to those analyst ratings for a buy, expecting that to kind of tick higher as it has in Hong Kong.
OK, Louise, thank you. Bloomberg's Louise Moon. We'll be back with the market open. We are still seeing a positive picture for European futures. We'll bring you that. US futures, though, pointing a little lower. This is Bloomberg.
Couple of minutes to go until European markets open this Friday morning. European futures are higher. I'll show you the numbers in just a moment, but let's track back a bit and show you why they're higher, because it's mainly centred on what we saw yesterday in the United States. This is where Europe went out. I hope you can see that line near the bottom of the session yesterday, at the beginning of the session, and we rallied after that into the close. Record highs hit in the United States. Europe has to play catch up. Asia already has, and that is why you are seeing this, which is my second chart, or second board, which basically shows European futures this morning, which are higher. We are up on Stoxx 50 futures by around 0.5%. FTSE futures are up by 0.6%. DAX futures are up by, let's call it 0.5%. So let's call it circa 0.5% higher in Europe this morning. Now, the wrinkle in this is that actually US futures are fairly flat, and that's down to what we're seeing potentially in Broadcom this morning, which is maybe pouring a little bit of cold water on the rally that we saw yesterday. So yesterday good in the United States, this morning good in Europe. This afternoon, what do we get in the United States? That remains the open question right now, Anna.
Yeah, US futures looking flat to negative right now, so we'll keep that in mind. Let's talk about some of the individual stocks, sectors that could be in focus then, Guy, given the handover from the US and some of the other news flow. So UBS in focus. A group of Swiss lawmakers is proposing a compromise solution in the debate over UBS's capital levels, which might mean that they can use some of their additional Tier 1 AT1 bonds to help them meet those capital targets. So we'll keep watching that story. ASML in focus. We had a great interview. Tom had a great interview with the CEO, but also Broadcom, certainly in our minds. Broadcom not able to reassure the market sufficiently around its prospects. This chip maker, of course, ASML makes the stuff that makes the chips. So we will keep an eye on the whole tech sector, but ASML is one part of that. Standard Chartered, that stock was up in the Hong Kong session after Goldman Sachs upgraded the stock to a buy, citing improving profitability and the chance it will raise its return guidance. Guy?
OK, here we go. Time for the European market open. We're expecting circa 0.5% in terms of the upside for Europe. That's largely a legacy of what we saw yesterday in the United States. And as anticipated, we are certainly seeing that move. The Euro Stoxx 600 is up by 0.5%. And now drops, actually, a little bit off the back of that. So I wonder what's just open to maybe take some of that out. We're only up now by 0.1%. We were expecting a little bit more. So I'm curious to dig into the details as to why that has happened. We are dealing with a little bit of a holdover from the United States yesterday. So, Anna, what are we seeing?
Yeah, in terms of the individual markets, the FTSE is up by 0.3%. The CAC 40 is up by 0.2. The Zetterdax is not yet open, so there's nothing particularly untoward happening there. In terms of the sectors that we have in focus, we've got travel and leisure is the best performing sector, and that's for the second day in a row. It was actually some of the travel stocks, Carnival, for example, that was moving higher yesterday. Today, I see Lottomatica is up, so that's a slightly different story. Technology is the second best performing sector, so that does not have Broadcom written all over it. Prosus is up by 1.7%. Perhaps that has something to do with the gains that we saw through the Asia session, because that was really strong, and they, of course, hold Tencent stock. And so MSCI Asia Pacific was up by over 1%. So maybe we're just getting that read across.
Tech is up in Europe, so that's interesting. ASML is the biggest points gainer. It's up by 1.31%. You've got SAP also rising too. Some of the other names, like Schneider Electric, is up by 0.6%. Where the heavy lifting seems to be coming through this morning, though, is in the banking sector, which is interesting. So we've talked about this UBS story. UBS is up by nearly 3% this morning and is the second biggest points gainer in terms of what we're seeing on the Stoxx 600. But HSBC is also higher. BNP Paribas is also tracking higher as well. So the big heavyweight banks are doing some of the big heavyweight lifting.
And Standard Chartered, sticking with that theme, also higher on the back of that upgrade. Quite a lot of upgrades and downgrades coming through this morning. So perhaps there's quite a lot of impact from some of that broker activity. Let's widen the conversation. Speak to Christian Mueller-Glissman, who joins us this Friday morning, Head of Asset Allocation Research over at Goldman Sachs. Christian, very nice to see you. It feels like it's been a sort of busy, slightly disconnected week. Next week looks really busy. To pick up on Guy's question in the first hour, how much are you trying to put 2025 to one side and focus on 2026, or are there still plenty of risks on the horizon in the very near term?
Well, I mean, the year is close to the end. I think it's the NFP. Everybody's watching the NFP. I think the Fed meeting turned out to be somewhat hawkish on the surface, but the assessment of the labor market was somewhat more dovish than what we actually had, where I think there was a lot of downward revision of the actual pace of job growth for the year. So that was really kind of a very good outcome for the market to work with going into year end. But I think now we need to actually see that NFP print and kind of understand how to start into 2026. But I would say that we're getting very close to ending the year on a very high note.
Yes, on a high note. Yes, indeed. I mean, touching new highs on US stocks and on global stocks. And so sticking with the stocks theme, actually, I wanted to ask you about how you interpret some of the sector performance. Just yesterday's session, which is a bit of a niche sort of time period to pick, but I thought it was interesting. Valerie was talking about this earlier. We saw a lot of cyclical stocks doing pretty well, and that was enough to sustain the stock market to a new high, even though some of the AI names and tech were in retreat. Does this tell us something about how stocks globally are, I don't know, ready to do without the AI training wheels, or what does it tell us?
I think we're definitely dealing with a new regime coming into 2026, where I think this year was all about AI capex, boosting the corporate sector, keeping growth optimism supported, but a bit narrow. And at the same time, you had a weak labor market, a K-shape, which actually allowed the Fed to be dovish. So it was kind of Goldilocks-ish, but not the usual Goldilocks, where you have growth picking up, kind of economic growth picking up with inflation going down. Inflation was actually quite sticky, if not picking up. So I think going into next year, it looks much more old school Goldilocks, where you essentially have growth picking up, you have the big beautiful bill, you have German fiscal spend ramping up, you have Japan fiscal spend ramping up, but you also have disinflation in the pipe. You still have a weak housing market, you have a weak labor market, you have the tariff impacts coming out of the inflation picture, and we're actually quite bearish on oil. So suddenly you actually get much more of a traditional kind of Goldilocks, and possibly that kind of widens the leadership a bit. There's more broadening out. And I think this is what the market is focused on, like a proper cyclical kind of impulse coming through the economy. And there's always the potential, especially if the Fed is a bit easy, that it kind of really accelerates, that you get proper releveraging and restructuring. And I think this is what the market is betting on right now.
Can they go too far? Like, the valuations are already pretty high.
Yeah.
You punch them a little bit higher. Aren't we getting into the kind of story where actually you could accelerate the economy too fast? You do get that inflation story coming back. How finely balanced is that kind of we can see a good economy, but it's an economy that doesn't yet deliver inflation?
Yeah, no, it's a very good point. Like, normally the best accelerations are early cycle, mid cycle, but we are a bit late cycle. Like, unemployment rates are low, profit margins are high.
Yeah.
We obviously have risk premia and that are compressed. Yeah. So you're absolutely right. Like, too much is not great. You have a speed limit that the economy and valuations are giving you for equity returns. But obviously we have AI, and I think there is a certain element of jobless growth, productivity.
That's what Powell's betting on.
Yeah, and I think it's right. I think as you see it already in the last few months, where the economy has done really well, the corporate sector has done really well with the weak labor market. Yeah. As long as that continues, that's important. But also really important, you need to keep the inflation anchored. And I think it's not going to be that difficult because you have these negative tariff impacts, at least initially, coming through. So inflation should normalize.
Okay. That doesn't sound like an environment, though, where I need a lot of rate cuts. The market clearly is highly sensitive to rate cuts. Do you think the Fed could be done? Do you think the ECB's done? Is the Bank of England done? Is the BOJ going to be hiking? Are other central banks going to be hiking? What does that rate trajectory look like next year? Because stocks have been really sensitive to this story.
So what I always think is, like, equity investors, they don't really care if you get 1 or 2 cuts from here. But they care if the Fed will cut when needed. And I think that's definitely the case. Yep. So if there is something going wrong in the economy, the Fed has a lot of room to cut, and I think a lot of inclination to cut. And the other question is if they will hike. And I would say that for the Fed, the bar to hike is still very, very high, considering that weak labor market.
But what about the bar just to leave things as they are? How high is the possibility we get no rate cuts or no rate hikes in 2026? And how does the equity market deal with a no rate cut, no rate hike kind of scenario?
It always depends on the interaction. Why is that? Is it because growth is better? We know equities can deal with rates going up and with possibly the Fed not cutting as long as the growth picture is good. But I think it's really dependent on the narrative at that time. Are they not cutting because inflation is picking up a bit? Are they not cutting because they're worried about financial conditions being too easy? We had this in the past where the Fed was actually saying what's going on in equities, what's going on in financial conditions is worrying them. That would not be good, obviously, because then you start to go from a Fed put to actually being short the Fed call, if that makes sense. But I would say that if the growth picture, which is always the most important driver of equities, is good next year, the market can deal with a slightly more hawkish Fed. It can deal with slightly higher rates. But I would say one thing that's important is the Fed is not the only central bank out there. Like, the Fed is at the margin currently still one of the most dovish central banks. You have Canada, New Zealand, Australia, where the market is pricing hikes next year. You have the ECB, of course, at the cusp of pricing a bit more of a hike, and quite some hawkish commentary recently. So I think the first half of the year, I think, will be a bit more growth rates tango. That's what I call it. Like, growth goes a bit too much up, that pushes up rates, which then weighs on growth. So you go back again, both of them go down. And that means you get a bit more volatility, like less Goldilocks-ish in terms of anchoring volatility, but the path, in our view, is still up.
Okay, so we have a growth rates tango, but we do have old school Goldilocks for next year then, Christian. So if we get old school Goldilocks, you want to be overweight US stocks. I think that's what your stance is for next year. But how do you protect? What kind of protection do you need? And what is the best protection if you're a little nervous about the US overweight?
Yeah, no, I think what we've been arguing a lot is regional diversification. So you're absolutely right. The US equity market has a lot of tailwinds. It has tailwinds from the big, beautiful bill. Also, the AI theme, to some extent, is still going, even though it's changing. It's changing from AI capex to maybe a bit more AI adoption, maybe a bit more AI applications. So you want to possibly diversify the AI theme in itself. I think we still like regional diversification. We actually overweight Asia. And we like EM, but Asia certainly has a lot of optionalities, both on the currency and the equity side. So to us, there's a lot of export competition from China, which is worth diversifying for Europe. There's AI competition for the US, which is worth diversifying via China. And we do actually think the Chinese currency is 30% undervalued. So we like Asia, but I think what we are very focused on going into 2026 is actually style diversification. So we like styles like quality, we like styles like low volatility, which have really done terribly in the last 2 to 3 years. And not to forget, the 3-year rolling Sharpe ratio on the S&P 500 is reaching the highest levels in 125 years.
Yeah.
So as you can, it's crazy, like, because you came out of 2022, and that actually means that quality styles that usually do better when the Sharpe ratio is lower, they might actually be a bit more valuable in a portfolio. And the last thing is, of course, we need to look at duration and duration proxies and safety. So we think the bond market in the first half, as we discussed, will potentially be a bit of a drag on the portfolio as the market reprices that kind of growth environment. But we do still see value selectively in duration. We've been overweight gilts, which are currently decoupling economically and have decoupled a lot on the central bank side for some time. So we're overweight gilts. And we still like gold. I think gold will remain a quite interesting asset next year, considering all the fiscal dimensions of that growth.
What's your biggest risk for 26?
We discussed it already. I'm very worried about inflation potentially picking up, giving us some.
Where does that come from? What will be the genesis of that inflation?
Well, you know, like in very simple terms, when you're late cycle and you're accelerating, you're often running out of stuff.
Yeah.
You know, you run out of labor, you run out of resources,
Yeah.
especially if there's supply disruptions. So we're watching very carefully copper, because if you ramp up a bit more economically,
Yeah.
it can support a lot of these cyclical commodities. We're actually not that bullish on copper because you had these supply disruptions boosting the price. So we do actually think the supply will help copper stay range bound.
Okay.
We're bearish on oil. If anything, the Russia-Ukraine deal could push down oil a bit, but we have to watch all these places where we can run out of stuff. Labor, another question, a big concern is the disconnect in the labor market between open jobs and people actually searching for jobs. Like there's a lot of college unemployment pickup right now, but the jobs that are open are car mechanics, people that put the glass into the buildings. Like this is not what a college graduate wants to do. So you could actually see, as the US economy accelerates in a more traditional way, bottlenecks in the labor market. So we're watching all of that. And the last thing I'm very worried about is, of course, the AI ecosystem. So we know there's a lot of money that's been put on the table that needs to essentially come back in some shape or form. So we need to monitor depreciation. We need to monitor trends for AI capex demand, if that makes sense, because you need to really now adopt and you need to make the applications and you need to make money. And I think this next year could be a bit of a show me year for the AI ecosystem.
So Goldilocks is still wary of the bears. There's still bears out there. Just
I think so.
Goldilocks needs to, keep an eye on what is going on. Be alert. Yeah. Don't just focus on the porridge. Christian, great to see you. Thank you very much indeed. Have a very happy holiday. CMG, Christian Mueller-Glissman, Head of Asset Allocation Research over at Goldman Sachs. Core 6 looks like this. Defence stocks on the front foot, which is interesting in light of what is happening in Ukraine. ASML, though, is leading the charge. We've got tech up, which is interesting, again, in the light as well, with what is happening surrounding the Broadcom story. Let's figure out what is happening in the banking story, though. Louise Ming has the details.
Yes, UBS is a big focus this morning. Shares ticking higher, the welcome news of Swiss lawmakers coming up with a compromise in terms of their capital requirements. So ticking higher, almost up 5% for UBS this morning. And then moving on to athleisure, a very different sector, but another one that we're focusing on in Europe. The potential ripple through story. Oh, sorry, firstly, we'll speak about Standard Chartered. They've been upgraded to a buy from Goldman, boosting that stock. This also happened in Hong Kong, so it's the same kind of reaction in the UK market, up over 2.5% for Standard Chartered. Next up is athleisure, as I mentioned before. Potential ripple through from Lululemon, positive news overnight. They boosted their full-year outlook. A new CEO, potentially some innovation there. So we're looking at Adidas, Puma, JD, all ticking higher, potentially on the back of that. Fraser's slightly down, over 2% there. So we'll be keeping an eye on that through the day. And then finally, we're looking at Lufthansa, the airline. They are higher into the green, up over 5%. That's after they've been raised to a buy. One of the few buys for the stock, so being taken positively by the market. So another one we'll be keeping an eye on through the day.
Louise, thank you very much. Bloomberg's Louise Moon with some of those stocks that are moving this morning. So European equity markets, they're not looking too bad today, making some modest gains. US futures flat and the S&P, Nasdaq futures down 0.1%. More on the markets when we come back. We'll also dive into that UBS story that Louise was talking about. Swiss lawmakers have proposed a compromise in the debate over the future of UBS and how it secures its self-sufficient capital to comply with Swiss regulations. More on that next. This is Bloomberg.
80 minutes into the equity market session this Friday, and we are certainly picking up with the legacy of what we saw yesterday in the United States and pushing higher. We're up by, let's call it circa 0.5%. We're now fully open. We've got the kind of numbers we were anticipating from Europe this morning. What is interesting is that tech is certainly doing a lot of the heavy lifting, but the banks are also having a fairly serious impact on what we are seeing this morning. One of those banks, and the standout one maybe this morning, is UBS. The stock is pushing higher. A group of centre-right Swiss lawmakers apparently proposing a compromise in the debate over UBS's capital. What they're proposing basically is that UBS will be able to use convertible bonds to meet its capital requirements. So you use, rather than kind of the super elevated stuff, you'd use AT1s, which are a bit cheaper but still give you the same kind of capital lift that maybe the Swiss government is looking for. Steve Aarons joins us now to talk about what is being proposed here. So basically, you have to get to the same level, but you can use cheaper AT1s to get there, seems to be the compromise, Steve.
That's the compromise solution that they're proposing. That's right. AT1s are a kind of junior debt that's cheaper for banks than equity, so it would make the whole thing a bit more feasible for UBS. And they've actually reacted and said, oh, OK, we're looking at this and it's going in the right direction. So a positive signal even from UBS on this one.
Right, yeah, so that takes me to my next question, which is, this is coming from the politicians. Does it sound like something that UBS would accept? It sounds as if they're being quite positive about it, and certainly the market is quite positive. UBS shares then Steve up by 4.5%, rising by 4.5% on the back of this proposal.
That's right. I mean, the capital reforms in Switzerland, just think about it. They're threatening to impose as much as $26 billion in new capital requirements on UBS, and that would definitely impact payouts to investors. So they have been worried about this scenario for a very long time. And right now, there's a lot of tailwind building for UBS that this will be watered down, and we won't end up at the $26 billion. We'll end up somewhere below it. That's the indication, and investors are piling into that bet now.
Steve, even though, would this still leave UBS at a competitive disadvantage? That's the whole kind of shtick here, that basically UBS feels that it would be at a competitive disadvantage because it operates at a global basis. Even if it was able to deliver the capital compromise using AT1s, would it still be at a disadvantage versus other kind of big global banks with which it competes?
The answer is yes. But, so yes, absolutely. I mean, new capital requirements that would only be imposed on UBS would definitely create a disadvantage for them, right? I mean, it would be the only bank that's facing this. But now that the prospect is actually declining a little, they've already thought about how to mitigate all of this. So the impact is less than what they thought it will be, and that's actually giving them tailwind right now.
Steve, thank you very much. Bloomberg's Stephen Aarons with the ins and outs of that UBS capital requirements story. Certainly one we will continue to follow as that stock back at levels we've seen in 2008. Far from 2006 levels, but back to 2008 levels for sure. Let's have a quick look at another sector that is on the move a little bit this morning. We've had some news flow surrounding management over in the United States, over at Lululemon specifically. So Adidas is up a little, Puma is up a little, JD Sports up less, but we are seeing a bit of a movement higher. Lululemon shares rallied in extended trading after the athleisure and yoga wear maker boosted its full-year outlook and announced that its CEO, Calvin McDonald, would step down. This after a prolonged period of sluggish growth. So let's talk about this sector and much beyond. Joining us now, Bloomberg opinion columnist Andrea Felsted with thoughts on athleisure. Andrea, so how much of the investment? Yeah, we all do. How much of this is all about the athleisure market then, and what Lululemon has been saying?
I think it's probably a bit about the CEO and a bit about the athleisure market. I mean, I think generally the market is a bit under pressure because fashion trends haven't been on its side. We've had a switch from leggings to wider pants, which other people have been doing better than Lululemon. Also, at the same time, we've got this whole revival of denim, which is a competitor to athleisure. Plus, I wrote this morning about the Ralph Lauren Christmas. I mean, the two are kind of linked because you've got this preppy return to sophisticated casual dressing, this quarter zip craze. That's all competition with fleeces, track jackets. So
yes,
the two are kind of linked together.
Your piece had me looking all sorts of fashion trends up this morning on my work Google profile. It's going to look like I was shopping. I was not. I was researching Andrea Felsted's piece.
Honestly.
Yes, honestly. It might be the 12th of December.
The quarter zip thing concerns me.
No, really?
No, I can't. I've got a lot of quarter zips. Believe you me, being fashionable is not necessarily high on my list of because everybody's going to be wearing them. Big competition for the quarter zip. In terms of kind of what we are looking at the moment, how does put consumer confidence next? What does that kind of going smarter thing tell me about consumer confidence?
I think it reflects a bit about back to the office. We're all going back to the office now.
I don't think we ever left, but okay.
Yeah, exactly. Plus, maybe a little bit of worry about the jobs market. You want to give your best. Yeah, give the best impression. So, fashion often takes its inspiration not just from what we wear, but how we feel. Another reason why Ralph Lauren Christmas was trending. When times are tough, we tend to, take comfort in the holidays, the traditions of the past. So it's all kind of linked, really.
Yeah, I was looking up that as well. There was a lot in those images. It's an assault on the senses at sort of 5 in the morning, Andrea. I'm going back to Lululemon because competition in the athleisure market. I mean, where does that leave them? Because they're not the cheapest in that space, and lots of other retailers have offerings.
It's a really competitive market. So you've got the Alo, Fiore, who are squarely in Lululemon's space. You've got Nike Skims, which after a delay seems to be doing well. But it's not just the premium brands. The high street's doing athleisure really well. You've got Inditex's got this Oysho chain, which does a good job. You've got
H&M has
H&M. Primark does a great job in the States. Old Navy's doing really well on its kind of more athletic wear. So, you can find the look whatever your budget.
What's next in the kind of if we're smartening up because we're more worried? What comes next? Dare I say it, ties? We're not going to go too far here.
I'm not sure, but we have definitely we are still seeing kind of corporate wear on the catwalks. Tailoring it's still a strong look. I think denim doesn't seem to be peaking yet. You often find things
denim
like
hasn't peaked.
I don't think denim has quite peaked. I've been expecting it to peak, but it's still seems strong. You often find things like cord come after denim. We're seeing a lot of velvet. I mean, that's more for party. But I think there's more to run on the sophisticated, casual, more dressing up side.
Okay. Andrea, thank you very much. Andrea Felsted, always a pleasure to see Andrea in the studio, especially on a Friday, and especially on a Friday before Christmas, where I feel this is a segment that you can take into your weekend and learn from. Not you personally, Guy.
I have never been ahead of the curve in my entire life, but
thanks to Andrea.
The quarter zip thing is well, yeah.
Stop the clocks.
I'm going to harsh, but probably fair.
Too mean? Sorry.
No, I think it's probably reasonably accurate. Maria Demertzis is going to be joining us shortly. We're going to talk about what is happening in Europe, the politics story front and centre in terms of Ukraine. We've got a busy week coming up next week. The ECB is going to be on deck as well. Lots of factors that we need to fold into our conversation with Maria. That is up next. This is Bloomberg.
This is the opening trade. 30 minutes into today's session. Let's have a look at where we are trading this Friday morning. Up by around 0.6%. Seems to be the main mood in the markets when it comes to the major continental European markets. The DAX and the CAC both up by that kind of measure. The FTSE 100 not far behind. So overall, a pretty decent session for Europe. Euro Stoxx 50 joining the global party and taking out those records. So it's taken out another record. We last touched this in November, I think, and now we've taken out another one. So a strong story for European stocks following a strong story in Asia and strength in the US session. So we're pricing all of that global narrative in. Broadcom, though, could weigh on US stocks as we go towards the US session, Guy. Might spoil the party a little bit. I like the talk of parties, though. Good way of looking at things. Let's talk a little bit about what is happening at the party, within the party, what's going on in the party, who's having a good time and who's not having a good time at the party this morning. Well, there's 458 up, so definitely those in favour of the party are winning this morning. 460 up, 126 down. Volume is also good, so the party's rocking. That is the narrative that we're getting. In terms of those that are enjoying it this morning, UBS is having a great time. That stock is up by 4.42% on this capital story that we were talking about just a moment ago. Lufthansa's been upgraded at Kepler. It's joining the party. ASML, on the back of Tom McKenzie's interview, is also enjoying the party, up by 0.9%. Sitting in the corner, not having quite such a good time. Let's talk about those stocks. Magnum Ice Cream, ironically, is actually not having a particularly good time this morning, down by 2.23%, reasonably spun out. It is off. And actually, there's a bit of a theme this morning, because the drink stocks, actually, interestingly enough, are also softer. Continuing the party theme. You've got also the likes of Nestle and Unilever softening up as well. So that kind of consumer-facing story, be it the high end or the low end, be it in the spirits or the deodorant kind of end of the market, that's where the weakness in some ways is in Europe this morning. I had another one, but Valerie Teitel made me take it out and said that I had to focus on also there's weakness in the pharma space this morning. The pharmaceuticals are also not having a good time at the party, and AstraZeneca is down by 0.8%. Well, maybe that fits. I mean, it's a pretty strange party. Let's put it that way. Let's get an update then, Guy, on some of the other stories we're focused on this morning. Data released this morning shows the UK economy shrank again in October, making it a fourth straight month without growth, as activity was blunted in the run-up to the autumn budget. The pound briefly edged lower after the data, while traders slightly increased bets on Bank of England rate cuts over the next year. The BOE's next rate decision is, of course, on Thursday. That's next week. Disney shares closed higher in the United States after the company announced it's licensing some of its iconic characters to OpenAI for use on the startup's video platform. Disney has also agreed to take a $1 billion stake in the startup. While the deal covers some of the firm's most or more famous characters, it does not include talent likenesses or any voices. And Donald Trump said the United States would be willing to help Ukraine as part of a security agreement to end the war with Russia. The comments came after his spokeswoman described the US president as, quote, extremely frustrated with both sides of this war. This as Ukrainian President Zelensky floats the prospect of a referendum on handing over the Donbass to Russia.
OK, let's continue that conversation and talk about what happens next. EU finance ministers meeting in Brussels today. This the bloc appears to be getting set to approve a deal that would let these frozen Russian assets be used to support Ukraine. Emergency powers are potentially being put in place. We're going to get around Hungary. We're going to find out a way of dealing with that. But the risks for Europe appear to be significant, and they have been laid out in rather sort of cold fashion by the NATO Secretary General, Mark Rutte. A stark warning coming from him on the need to get ready for the possibility of all-out war with Russia.
Conflict is at our door. Russia has brought war back to Europe, and we must be prepared for the scale of war our grandparents and great-grandparents endured. Imagine it, a conflict reaching every home, every workplace. Destruction, mass mobilization, millions displaced.
Well, that's a cheery outlook for Europe as we kind of think about what could come next. But that worst-case scenario increasingly being kind of modelled out and mapped out by many European leaders. Our chief Europe correspondent, Oliver Crook, joins us now at the European Council in Brussels. It kind of reinforces the idea that we need to get a peace deal. We need to get this conflict in Europe sorted, though it doesn't ultimately kind of take out the Russian threat. Where are we now in terms of that process? And the latest comments, fold them in, from President Trump.
Yeah, let's deal with the American side of this first, the comments from Donald Trump. I mean, the first reflection that he's grown very impatient and he'd like to see something done immediately. He likes warp speed diplomacy. That is not something terribly new. I think there were two things that were new that we heard from Trump yesterday. First, it was the president speaking openly about security guarantees for Ukraine. We've talked a lot in the abstract about security guarantees for Ukraine. We don't know what form they would take, how much of it would be assured by the Europeans, how much of it would be assured by the United States. And this is one of the first times that we have Donald Trump openly talking about it and saying that he is willing to contribute in some manner or another to those security guarantees. We should say he did not sort of elaborate on what kind of security guarantees they would be, but it's at least an acknowledgement from the President of the United States that it's something that the U.S. is willing to do. The second thing we're looking forward to is this weekend when there is a high-level European leaders meeting about Ukraine that will involve the Ukrainian delegation. We understand that they would like the United States to participate. That being said, Trump says he will really only send a delegation to participate in those talks if he feels that they're going to be their progress is going to be made, that they're not talks for the sake of talks, meetings for the sake of meetings, which is one of the great frustrations for the president.
And thinking about how we get to some kind of resolution, some kind of peace in Ukraine, Ollie, what has President Zelensky been suggesting around the Donbass? He's talking about voting on elements of handover to Russia. Talk us through the detail there.
So this is a really interesting approach by President Zelensky, and I think it's rooted in the fundamental premise that has led his foreign diplomacy with the United States ever since the catastrophic meeting in the Oval Office back in February, which is basically this initial premise, that there are no bad ideas out of Washington, D.C., no matter how confrontational they appear, no matter how difficult they are for the Ukrainians to agree with, he will always work with it and try to use the momentum of those ideas in order to get it to a place that is helpful to Ukraine. We've seen that twice this week already. The first was on this question of holding elections in Ukraine. Zelensky said that basically if the United States could assure security for those elections and Europe, they could assure the situation and the conditions for safety in Ukraine for elections, he would hold elections in the next 60 to 90 days. So basically going with the American initiative, and one of the critiques that Trump has said that basically it's no longer democratic, and he's called Zelensky a dictator in the past, he sort of finds a way to abate that criticism while also bringing this vote potentially to the Ukrainian people. The second thing is bringing a referendum on whether or not to surrender territory effectively in these trade negotiations or these peace negotiations with Russia, and putting that to the Ukrainian people. That is, again, clever for two reasons. One, it takes the initiative out of Zelensky's hands. If the Ukrainian people, after they have voted, say we are willing to endure more war, that is not Zelensky sort of providing any kind of impediment to the peace process. And the second thing, of course, what it does is it puts on full display that Ukraine is a democratic nation, in very sharp contrast to its opposition to Russia.
Let's talk about frozen Russian assets. Are we about to take them out of the deep freeze?
So that is the sort of big question here, Guy, and I think that, there is a lot of positive momentum. There's a lot of positive noise from a number of European leaders over the last couple of days. There are still some hurdles. What we're expecting today from the Europeans here is to basically use emergency powers to circumvent Hungary and Slovakia in order to get these frozen Russian assets on ice, basically indefinitely. This would basically prevent this from being every time a unanimous vote, one of qualified majority. That's obviously contentious for a number of reasons, but that is a prerequisite to being able to use these Russian assets indefinitely, and that is basically what we expect to happen today. What then gets kicked into next week is whether or not they're actually going to seize these assets meaningfully and monetize them, and frankly, we don't have the answer to that yet. Despite all the positive rhetoric we've heard from a number of European leaders, we still have not heard from the Belgians that they are 100% satisfied with the assurances that the EU are giving right now. So that is what we're going to be watching for. That is what we're going to be listening to finance ministers as they walk in here for the rest of the day. And going into next week, I think that this is absolutely critical for Europe. This is the frozen Russian assets, and the 90 billion euros that would go to funding Ukraine is the only meaningful thing that the Europeans can contribute to this peace process. It's their only piece of leverage in these negotiations. If they fail to do so, they will be faced with the reality of European leaders talking about the importance for 4 years of supporting Ukraine and basically failing to do so on the only thing they can contribute right now.
Ollie, thanks very much. Bloomberg's Oliver Crook in Brussels. Let's continue this conversation. Joining us now for more on Europe from a slightly more economic perspective, but picking up on some of these themes, is Maria de Mertzis, leader of Europe's Economy, Strategy and Finance Centre at the Conference Board. Maria, really nice to have you with us. We want to talk about the ECB a little bit. I know you've got some interesting things to say also about confidence amongst business leaders, or lack of it, so we'll get to that shortly. But we were just hearing there about these conversations on Russian assets and what Europe can do do there. Do you understand why this is such a stumbling block for Belgium? I understand fully that a lot of the assets are in Belgium, but why does it seem so difficult to craft something legally that can reassure them that they won't be on their own if there were to be some pushback from using them to secure a loan to Ukraine?
It really has to do with the fact that the assets reside in Belgium. And if there were to be a legal process started from Russia, and I actually say there will be one, then there will be a legal costing involved with all of this. And of course, there will be an issue of risks for what happens to the assets themselves, who pays them back. And this is what Belgium worries about, given that it is that will be the frontline country that will have to answer that question. What Belgium is asking for is a mutualization of risk. It is asking its European partners not to have to deal with this issue alone, to have to deal with this collectively as European Union. That's all it's asking. Is very reasonable, and I think that we will find a solution to that.
Yes, and there has been talk about that being fine. I've certainly heard European leaders saying that they will try and craft something. So we'll look to next week maybe to see if that comes to pass. Is there risk in this for the European banking system, and then as a link to that, the European fiscal authorities, European governments? Is there risk if Ukraine does not pay back the money, for example?
There are always risks, but we are talking about 210 billion. So these are substantive amounts, but they're not catastrophic in terms of how big they are in the European Union, what they represent in terms of proportions. I think there are risks, but if you put the whole fiscal side of the European Union, meaning the governments behind it, I just don't think that will be a systemic problem either for the banks or for the fiscal authorities. It is a risk. There is nothing without risk, but it is contained if the European Union throws its collective back on it.
Maria, if there was a peace deal, what would it mean for the European economy? Is it possible at this point to get a clear idea?
It's quite far off, I think, but if you were to dream of what that would look like, they will have to think about ways of reconstructing Ukraine. First, safety Ukraine, who provides the safety, and then after that is reconstruction. I don't think we know what that will look like, but I would imagine the US will have a big deal, a big role to play there, and I'm hoping also that the EU will have a big role to play there, also in view of Ukraine becoming closer to the EU with the future membership of the Ukraine, if not this decade, maybe the next.
OK, let's talk more kind of near term and what is happening next within Europe. When do you think the first ECB rate hike is going to come? Are we going to see it in 2026 or is it a 2027 story?
It depends on how the risks are evolving. For all intents and purposes, inflation in the euro area is now exactly what it needs to be. It wobbles a little bit on one side and the other. We saw in the last month an upside on the inflation, which was a little unexpected, but nothing to cause any hurry. And therefore, the forecasts that are also very much on the target are not raising any concerns. I just don't know what the balance of risk will look like, depending also on what the situation of war will look like in 2026. The prospect of peace is very helpful, but it's not guaranteed at this moment. I think if we were to have a rate hike, it would be close at the end of 2026 and not early 2026.
OK, so that's the ECB next week. Maria, you have been thinking about the climate for business in Europe, which of course links us into the ECB. You do regular surveys of CEOs and their confidence. And you talk about how the view from CEOs you've been talking to is that the Draghi reforms are not advancing fast enough. Now, we've heard from one CEO, one CFO this morning, who have both talked about Europe falling behind. This was ASML on chip manufacturer. This was Schneider Electric on data center rollouts. Is there any kind of momentum building to move faster on those Draghi reforms?
Yes, I think unfortunately, the issue of the war has really sidetracked all of this conversation. That's very, very unfortunate. We need to make progress, parallel progress on economic reform and on security. And that is actually, I think, what is holding us back. Indeed, what we hear from the CEOs is that although their confidence has increased by comparison to 6 months ago, they're still in negative territory. And they're telling us that they feel a lot more confident about areas outside the EU than inside the EU. And that includes both the US and China, which is really unfortunate. unfortunate. They also do see that the progress made on the Bragg report lags behind, and they actually blame the countries for this. They think it is member states that need to coordinate better, and they are advanced on the reforms. So in that respect, the news that are coming are not so good in terms of how fast we are moving in improving the competitiveness agenda. And I hope that this helps concentrate the minds in Brussels and in member states in kind of making better progress in that respect.
Maria, you talk to a lot of people in Brussels, you talk to a lot of people around Europe. Do you see any prospect of the UK joining a customs union with the EU? Do you see any prospect of single market access? This debate is beginning to start in the UK in earnest, it feels. And I'm wondering what you think it looks like from the other side of the fence.
I think you'd have to put it low in the priority list at the moment. There's so many other issues that need to be fixed. But where I do believe there will be progress is on defense. And that, of course, has got single market aspects to it as well. But that's what we need to make progress on. Find a way of allowing the UK to participate in defense projects in Europe. That will be the first step. And once this is established and will also serve our preparedness efforts, then we can think about how to make closer ties with the US. But as you can imagine, for the moment, there's so many other issues that are crucial for the EU, and they're exactly the first priority right now.
Got to bring something to the party. Maria, thank you very much indeed. Maria de Mertzis, leader of Europe's Economy, Strategy and Finance Centre at the Conference Board. Thank you very much indeed. Staying with the UK, coming up has to do UK's soft GDP reading for October. Giving the Bank of England more room to cut next week, we'll discuss the latest when it comes to the UK economy, and we will do so next. This is Bloomberg.
Welcome back to the opening trades. We are currently 50 minutes into a European session. If higher stocks is what you wanted for Christmas, we certainly have that today. New highs for European stocks by some measures, global stocks, US stocks. That's been the story of the past 24 hours. Maybe things get a little trickier from here with those Broadcom negative sentiments coming through from that earnings story. But let's think about next week and see what that has in store, because it's going to be busy. And so we thought it was worth getting a head start on what to look out for. Tuesday, US non-farm payrolls, UK labour data as well. UK CPI on Wednesday, Bank of England decision, ECB decision, both of those fall on Thursday, and then US CPI also on Thursday, and a BOJ decision as well. I mean, not much then, Guy. Not much happening.
No, but in some ways it's good. Because there is this danger in December that nothing happens.
That is dangerous.
And from our point of view, that makes life very, very difficult.
This might keep more people paying attention, a bit more volume in markets, perhaps.
And something for us to talk about.
Yes, that also helps.
Which is also
we
useful.
still have 2 hours to fill, so yes. Now, the UK economy disappointed again by contracting in October, a fourth straight month without growth. Traders have slightly increased bets on Bank of England rate cuts over the next year. For more, let's bring in our colleague Dan Hansen, Chief UK Economist for Bloomberg Economics. Dan, good morning. Happy Friday to you. And not a happy Friday when it comes to these GDP figures. And this is many months now of negative prints. What's happening?
Yeah, morning. It's not a pretty picture, is it, for the UK at the moment? I mean, I think when you look at this data, particularly just the October data and actually the September data as well, there are a couple of one-offs in there. We had the closure of the Jaguar Land Rover factory. It came back online in October, but it's ramping up production. It ramped up production slowly. That permeated through the wider economy as well, which is why we had some additional weakness in October. And of course, the other thing we've had is the uncertainty about what was going to happen with the budget. And you imagine that the November data could potentially be impacted by that as well. So you've got these one-offs, but I'd also highlight a couple of sort of what I would call more longer-term structural issues that are impacting the UK, the most significant of which is around the consumer. If you look at the behaviour of the consumer in the UK, which is obviously consumers are the biggest spenders, 60% of GDP, they're very cautious. And I think that's one of the issues the UK is facing. We've got these one-offs that are impacting the data, and every month we seem to have a one-off reason to explain why GDP fell. But actually you've got these longer-term issues as well that are keeping a lid on demand.
Dan, in a moment, Anna's going to ask you a question about what the Bank of England's going to do next week. I'm assuming she will. It's the kind of end of this process. We've got a load of data that we need to focus on next week. CPI looks like it's going to be one of the standout stories. It still looks sticky. Headline numbers still north of 3%. You've got core numbers that are still very elevated as well. In terms of what we should look for in those numbers, there doesn't seem to be much improvement at the moment. We still have sticky inflation in the UK. Is there any sign that that problem is going away anytime soon?
I think there are a couple of things next week. So you're right on the CPI. I mean, we think, at the moment it's at 3.6. We think it'll probably come down to 3.5. Stay around that level in December for the December print as well. Moving into the first quarter, we do think you'll get closer to 3%. And then actually the big moment for CPI and UK CPI, at least on a headline basis, is going to be April. Because we had in the budget this news that a lot of the policies would weigh on CPI inflation. And I think you're going to get a pretty big drop in the April data back closer, not quite to 2%, but somewhere a little bit above 2%. I think the interesting story is what's going to happen on an underlying basis. And that at least thinking about the data next week, look at the labour market data. Unemployment's probably going to go up again. Wage growth is going to slow, probably below 4%. And that's going to be a good news story for underlying inflation. It's just going to take a lot longer to come down, though. And I think if you're thinking about...
Dan, just very briefly then, you are expecting the BOE to cut next week, right?
Yes, we are.
OK. We'll have the rest of that answer next week, because we have plenty of time to talk about the UK. Dan Hanson, Chief UK Economist for Bloomberg Economics. There's much more working goes into that, I'm sure. Shall we talk to Val?
Yeah, what are you looking at next week?
The delayed November data that's going to be published, both CPI and non-farm payrolls. There's a lot of confusing details in both of these prints. They're both going to be essentially double prints. So let's start with non-farm payrolls. We aren't going to get the unemployment rate for October, so we're only going to get that one for November. But Bloomberg Economics sees that there's a risk that this could be quite elevated, near 4.6 to 4.7%, so a decent tick up. And that's around whether the furloughed workers around the government shutdown answered the survey correctly. In past shutdowns, they actually haven't. It's led to some blip in the unemployment rate. The other thing to watch is the CPI print that we do get on Thursday. A lot of distortion could be at play here. We are going to get a few components from October, from the month of the shutdown. We're going to get the full slate from November, but Powell really talked about this at the press conference. He said, be wary of this November data. It could be distorted. I think he was more talking about CPI when it comes to this, because some of these components in CPI aren't collected every month. So you miss a month and you happen to maybe get a hot month or a cool month, it could distort the data for months to come. So keep an eye out for that. Bloomberg Economics expects October and November to show 0.3% core CPI inflation.
OK, before that, we have a weekend to enjoy. I had a brief look at what's coming up this weekend on our sort of, thinking about the weekend graphic. And there's barely any sport. I mean, granted, there's a darts championship, but that involves a lot of fancy dress.
It's very marginal.
Yes,
darts
exactly.
Sport,
so I looked at this and thought, this does not have Guy Johnson written all over it. I don't know what on earth are you going to do all weekend,
there are downhill races.
There we
Skiing.
are. That's the answer.
There you go.
Find other sport.
Yes, there's always sport. Of course there's sport. There's all kinds of things going on. Don't dismiss the darts. Anyway, great weekend coming up. We've got plenty to think about going into next week. Normally you'd be out Christmas shopping, but I feel you've got to gen up. Next week's going to be huge. Bank of Japan, ECB.
Thank you. You're setting me homework.
Oh, yes.
Thank you very much. Christmas gifts from Guy Johnson. That is it for the opening trade. The Pulse is up next. European equity markets enjoying this rebound this morning. US futures a little more mixed. This is Bloomberg.